Industrial loans and conventional loans. RBI issues guidelines from time to time for the credit operations in the banking system in India. RBI expresses its views on the economy through changes in its monetary policy called Annual Policy Statement in the month of April. This policy is reviewed on a quarterly basis and it also conducts a mid-quarter review. For policy purposes, the months from October to March is known as busy season and the months from April to September is known as slack season. After the liberalization policy, the name of credit policy is changed to monetary and credit policy. The policy aims to achieve availability to ensure non-inflationary growth and fine-tuning cost of credit to achieve productivity in set sectors. Also, money supply targets are set by adjusting CRR or cash reserve ratio and SLR or statutory liquidity ratio. The policy aims to achieve an intermediate course for entire functions in economy and also acts as a fine-tuning device for achieving targets in the annual budget. Commercial real estate exposure. The following exposures are classified as commercial real estate or related, namely loans extended to builders towards construction of any property intended to be sold or given on lease, loans for multiple houses to be rented out, exposures towards development of CES, loans for integrated township projects, exposure to mutual funds and venture capital funds investing in real estate companies, etc. Capital market exposure. Banks' capital market exposure includes both direct and indirect exposures, namely direct investment in equity shares, convertible bonds, debentures, and units of equity-oriented mutual funds, the corpus of which is not exclusively invested in corporate debt. It also includes advances against shares, bonds, and debentures or other securities to individuals for investment in shares, convertible debentures, units of equity-oriented mutual funds, and convertible bonds. Also, advances secured by collateral security of shares or convertible bonds or debentures, secured and unsecured advances to stockbrokers, and guarantees issued on behalf of market makers and stockbrokers, loans sanctioned to corporates against security of shares, bonds or debentures, bridge loans to companies, etc. Infrastructure sector lending. Infrastructure is mentioned as anything including telecommunications, power, roads and bridges, railways, seaports, airports, industrial parks, mining and development, urban infrastructure, etc. Any credit facility extended to an infrastructure facility comes under infrastructure lending. This means any credit facility which is given to a borrower company engaging in operating and maintaining development of infrastructure projects in the said sectors qualifies under infrastructure sector lending facilities. Demand time liabilities. Demand liabilities of a bank would mean current deposits in a bank, margins held against letter of credit, balances in overdue fixed deposits, cash certificate and recurring deposits, unclaimed deposits, credit balances in CC accounts, and demand liabilities portion of savings fund deposits, etc. Time liabilities means fixed deposit, cumulative and recurring deposit, time liabilities portions of savings bank deposits, staff security deposits, cash certificates, and margins against letter of credit not payable on demand, etc. Cash reserve ratio. Cash reserve ratio is the ratio of balances of the bank's cash reserves with Reserve Bank of India. It is calculated on the basis of bank's net demand and time liabilities to make sure scheduled banks' solvency and liquidity. Under RBI Act 1934, Section 42(1), all scheduled banks are required to maintain minimum cash reserves with the Reserve Bank of India. Normally, 3% to 20% of the net demand and time liability has to be maintained with RBI as per RBI Amendment Act 2006. According to notification from RBI with effect December 2002 on a daily basis, it should maintain a minimum of 70% of average balance in banks. CRR is kept as cash balances with RBI. No interest shall be payable by the Reserve Bank. Statutory reserve ratio. According to Section 24(2)(a) of the Banking Regulation Act 1949, every banking company is required to maintain in India, equivalent to an amount at the close of business on any day, a percent of total net demand and time liabilities, which is statutory liquidity ratio. SLR is kept as cash in hand, gold and investments in approved securities. Interest may be payable by the Reserve Bank as per investments made in different securities. Banks' exposure norms. The aggregate exposure of a bank to the capital markets should not exceed 40% of its net worth as on 31st March of the previous year. Also within this limit, the bank's direct investment in shares, debentures, convertible bonds, and units of equity-oriented mutual funds and all venture capital fund exposures should not exceed 20% of the bank's net worth. Bank's capital market exposure. Bank's capital market exposure is computed by taking into account loans and advance sanctions and guaranteed issues of capital market operations would be called for or reckoned with reference to amount outstanding or sanctioned limits, whichever is higher. For term loans that is fully drawn, when there exists no scope for redraw of a portion of sanctioned limit, banks consider for exposure the outstanding amount in all cases. Credit delivery and loan systems. Loan system was introduced by Gilani Committee during 1995 to minimize the risk of cash and liquidity management on part of the banking system, which was seen to happen because of volatile movements in cash credit component of working capital or caused by working capital in general. Accordingly, banks consider 80% of loan component and 20% of cash credit component for borrowers in standard and substandard category enjoying working capital limits of rupees 10 crores or more. Selective credit control. From time to time, the Reserve Bank of India, according to Section 21 and 35A of the Banking Regulations Act 1949, issues directives to all commercial banks in an attempt to prevent speculative holding of essential commodities with the help of bank credit, as well as to prevent resultant rise in their prices. Commodities that are covered under selective credit control includes buffer stock of sugar with sugar mills, unreleased stock of sugar with sugar mills, etc. On unreleased stock of sugar with sugar mills, if it is representative of free sale sugar, banks can decide the margin of its sales. Consortium financing. Under this agreement, bank join by way of an agreement and meets the working capital needs of the borrowers. In the case of project financing, the term lending institutions and banks come together for an individual consortium to frame their own norms for consortium lending or financing. This is according to RBI Directive October 1996. In consortium lending or financing, the lead bank is responsible for the preparation of notes, in particular the appraisal note, and the related arrangements in terms of its circulation, arrangement for convening meetings, the fee for which is charged from the borrower. Credit risk management. Credit risk management is the management of risks encountered by banks when they act as intermediaries, and the typical credit risks encountered by them are financial and non-financial risk such as interest rate risk, credit risk, foreign exchange risk, equity price, liquidity risk, price, commodity price risk, operational risk, reputational risk, legal and regulatory risk. The credit risk refers to the possibility of loss suffered by a financial institution or a bank as the counterparty who is the borrower who by virtue of operating in an environment filled with uncertainties results in operating in such a manner where situations are filled with threats to the sustainability and viability of their own activities. Credit risk is made up of transaction risk, which is resulting out of individual transaction risk, or counterparty or borrower default in payment, portfolio risk, which is concentration risk which arises out of undertaking exposures only in certain industries as opposed to the entire portfolio, or intrinsic risk, which is risk in terms of activities due to operating environment. Non-performing assets or NPA. A non-performing asset is any asset on which loan payments are in arrears or are in default and which in turn relates to past due, any loan payment which is unpaid for a period of more than 30 days from due date. Some of the examples of NPA are term loans and bills overdue for a period of more than 90 days, overdraft account overdue for more than 90 days, agricultural loan which is due for more than 2 crop seasons, etc. The loan accounts are classified based on general quality of portfolio and also based on general provisions against loss suffered in loan delivery and handling. The classifications hence for NPA are 1. Standard assets, which does not disclose any problems and do not carry more than normal risks attached to a business. 2. Substandard assets is one which has been classified as non-performing asset for more than 12 months. 3. Doubtful assets, which are assets which has NPA remaining for a period of more than 12 months. And 4. Loss asset, where the bank or internal or external or RBI auditors has identified an asset as a loss asset. Example may be an advance or account with no securities, etc. Debt Recovery Tribunals or DRT. Debt recovery tribunals work under the provisions of Recovery of Debts Due to Banks and Financial Institutions Act 1933. A DRT jurisdiction covers loans of banks and financial institutions of more than rupees 10 lakhs, and as per Section 18, no court other than a debt recovery tribunal has jurisdiction over such loans which are mentioned above. Headed by a presiding officer appointed by the central government for 5 years, there also exists a registrar to take care of administrative matters. After the claim is upheld by a DRT, it hands a certificate to recovery officer, and the recovery officer has powers in execution to attach, sale, arrest and appointment of receivers under 2nd and 3rd schedule to the Income Tax Act. Asset Reconstruction Company. An asset reconstruction company is a company incorporated under Companies Act 1956 who manages the activity of financial asset reconstruction, including sale of assets charged, takeover of management, as well as securitization of assets. By asset, it means loans, advances, and investments made by the financial institutions and banks to a company or a concern. Asset Reconstruction Company or ARC acquires non-performing assets, also distressed assets from banks and financial institutions at a discount and initiates steps to recover these loans by way of securitization, sale or reconstruction of assets. Lok Adalat. Lok Adalat are created under the Legal Services Authority Act of 1987 and has jurisdiction to determine and arrive at a compromise or settlement between parties to the dispute. It is similar to a civil court which can be organized by a state authority, district authority, Supreme Court Legal Service Committee or a High Court Legal Service Committee. Types of charges on security. Creation of a charge by borrowers on various securities or assets means creation of a right in favor of a bank in order to get payment of the loan amount out of the charged security. The following types of charges exist on securities, namely hypothecation, pledge, assignment, and mortgage. Hypothecation. According to Securitization and Reconstruction of Financial Assets and Enforcement of Securities Interest Act 2002 or SARFAESI Act, hypothecation is defined as a charge on any movable property which is in future or existing, which is created by a borrower in favor of a secured creditor without delivery, possession of that property, and acts as a security for financial assistance, including floating charge, crystallization of such charge into fixed charge on movable property. Pledge. In pledge, the legal rights are made in such a way that ownership remains with the borrower and possession of the securities lies with the bank. Pledge is according to US 172 of Indian Contracts Act, which is bailment or delivery of goods as security for payment of a loan. Mortgage. According to Transfer of Properties Act 1882, a mortgage is a transfer of interest in a specific immovable property for the purpose of securing payment of money or an advance by way of a loan on an existing or future debt or by engaging in performance which may give rise to pecuniary liability. Assignment. Assignment is transfer of a claim which is actionable and may be existing in future as a security for a loan. The transferee is called assignee and transferor of such a claim is called the assigner. Assignment is according to Section 3 of Transfer of Properties Act. An actionable claim means a claim to any debt other than a debt by mortgage, hypothecation or pledge.